Alrighty, well, let's get going. Hello, everyone, and thank you very much for joining our quarterly webinar, Opportunity Knocks. I'm our reader and look after marketing at Talaria. And before I hand over to Hugh and Lance, a few housekeeping things. The mics and the cameras have been turned off to limit background noise and distraction. However, please use the Q&A function at any time, and I'll ask them on your behalf at the end of the session. So with that, I'll hand over to Lance and Hugh.
Thanks very much, Al. Ladies and gentlemen, thank you for joining us today. A few hundred people on the call. So with that in mind, Hugh, let's get into it. Welcome to another quarterly Opportunity Knocks, which hopefully we unpack in this session. Now, Hugh, the investment team have discussed developments recently that have really a material, longer-term implications for investors. And in fact, you said to me the other day, Lance, the longer your investment horizon, the more this should matter. So with that in mind, help me understand what we're looking at.
Yeah, thanks, Lance. Cool. So this first slide is simply showing you the current account balance by region, divided in really three regions, so rest of the world, Europe, and the United States. They're the coloured bars. The way to understand this exhibit is anything above zero, so anything that's positive, is suggesting that that region earns more from global trade and income flows than it consumes. Of course, anything below zero means that you are earning less from international trade and income flows than you're spending. This chart goes back to 1800, and what we've done is we've overlaid with that in the shaded areas the different regimes under which that global trade operated. So you can see, the gold standard really from kind of 1870 to 1930, and it's quite natural that capital flows vary between regions over time. It's our contention in really a number of the recent quarterlies that we are in a period where we are negotiating our way to a new understanding, a new regime of the monetary system. The real reason that we're showing this exhibit to start with is two things. One, it always sounds a little grand to say, hey, we're going into a different era or, a generational change. So it's easy to get jaded by that. So the first point here is the shaded areas suggest that this is quite normal. It ebbs and flows, as you can see there, over the last 225 years. So the fact that it's changing in and of itself is not notable. And the second key thing is that you can see the amount of capital ultimately, so the income earned by the US has been deeply negative since what we've termed the era of globalization, which we mark as really starting in the very early 90s with the accession of China into the global trading economy, and of course the fall of the Berlin Wall at the end of the 1980s. But this has profound implications for the kind of assets that will perform going forward, and indeed the return expectations from a whole range of assets that a lot of investors over their lifetime have become accustomed to.
So we're thinking about a regime change, which it feels like we're talking about the era of globalization now moving to something new, something different. Taking a step back, though, across a number of asset classes, the ride for asset owners over the last 30 years has been pretty good. Maybe we could unpack what's driven that statement of pretty good.
Absolutely. So the era of globalization has had many positives.
Yeah.
I mean, clearly the largest reduction in global poverty ever. Let's not forget that, we live in a world of people, so that's a tremendous positive. We all collectively, as consumer of a whole range of goods and services, have seen the cost of them in real terms come down as we've moved into a globalized era rather than a localized era of manufacturing. And of course, what we've seen as well is that you're looking at here, and your implication is that it's been very positive for asset owners. And the reason for that is, we talked about this on the last quarterly, but very briefly, that first principles approach, if you know the return you want from an asset, you know the nominal cash flows that come off that asset, and you know your cost of finance, then you know precisely the value to pay for that asset to get that return. And we're showing this slide here where the dark blue line is the increase in nominal cash flows starting from that period of globalization that I marked as being in the early 90s. From here, it's 1994. So if we sat here in 1994, we were talking about the outlook for markets, irrespective of starting valuations, we would have underestimated the nominal cash flow growth that came off assets over the period that we're looking at on this chart to 2025. And of course, the reason for that is that the cost of production in many industries fell because, capital moved and physical capital moved to lower cost manufacturing areas particularly. So that has benefited in real terms that nominal cash flow growth, but also in real terms been much stronger than we would have anticipated. The second thing is that teal line is that cost of finance. So that's the second input to work out the price to pay for an asset to get the return that you want to generate. And because of those huge current account imbalances that we showed in the first slide, there's been a huge recycling of capital, really from the rest of the world and Europe, and it's gone into funding, effectively the US consumption of capital, but it's kept the cost of finance lower than one might have anticipated where we sat here in 1994. So you've had both the cost of finance would have been forecast to be too high that you were using in 1994, and the nominal cash flow growth off assets would have been too low. And that's resulted in an extremely strong tailwind in all asset classes, real estate, fixed income, but also equities, that have meant that you've had a tremendous tailwind where at most moments in time, as long as you could hold the assets, you've seen simply higher and higher valuations in those assets. And that's been a huge contributor to the excellent returns that investors in all asset classes have enjoyed over that period.
And if I remember correctly, last quarterly, we spoke about this and we titled End of an Era. So sometimes a big call on end of era.
Yep.
I think the other thing that we then transitioned to in this quarterly was the discussion around debt. So the focus for this quarterly very much on debt. Again, I think we focus a lot on the US, but the outturn of that regime change is not, in terms of debt, is not unique to the US.
100%. So we've touched a couple of the positives is this era of globalization, but clearly alongside that have grown some structural imbalances. And we name checked a couple of them last time. The mismatch in terms of the global manufacturing base. Remember in 1994, China, for example, represented 4% of the world's manufacturing base, and now it's 34%. And I think in many industries, there's a recognition within region or within countries that they don't want to be so reliant on a single region or single supplier in terms of that global supply chain, which obviously makes sense. And we're seeing a policy response to try and readdress that balance. I think we've seen, secondly, a persistence of fiscal deficits. So larger and larger ongoing fiscal deficits year after year. I mean, the US is on track really to be about the largest outside of COVID and the Second World War again this year. And that's really funded and allowed the level of debt to never be higher in really the world. Okay. And what we're showing here is the G7. So Japan, France, Canada, all well over 300%, but of course China as well is well over 300%. The reason that I would suggest that number is it's worth bearing in mind Greece. I remember all the turmoil in 2011 and 12. That had debt to GDP of about 297%, and we're well above that and forecast to continue to grow all around the world. So when we talk about that Jaws effect, one of the reasons that we're suggesting that we're at an end in an era and therefore that positive Jaws effect at the very least is no longer going to be a tailwind is that these structural imbalances are starting to be addressed. And of course, the returns to capital versus returns to labour has given rise to populism in many places in the world. Eastern Europe, clearly France, Holland, the US would be on top of many people's minds as well. And that is a function of a limit that we're reaching. But specifically in this quarter, we talk about how debt and the negotiation to a new era of really a multipolar world means that those flows of capital can no longer be relied upon.
I think I've heard you describe it before as a fight for capital.
100%. It was interesting for those of you that read the Financial Times. We were discussing on the desk in the investment team just yesterday. There was 2 headlines in the Financial Times. The Canadian government urging the Canadian pension system to invest more money in Canadian assets. In the UK, the Chancellor Rachel Reeves suggesting there would be changes to the tax advantage savings system where you would have to channel that money into domestic UK assets or equities. You'd get a tax break to do that. Clearly, defence has been a topical point, particularly in Europe, where they have, in this multipolar world, recognised that they will increasingly be responsible for their own defence from a geopolitical sense. And of course, they've made in several countries in the European Union commitments to spend 5% of GDP. So all of that actually is earmarking money for domestic or regional agendas rather than being able to continue to fund what has been that meteoric rise in the capital consumption in the US. So absolutely. I think the end of globalization could be characterized not only as a change to the monetary regime, but really a fight for capital. So I think that is likely to very much be the case over the coming investment horizon for all investors and all of us.
Sure. Now, if we could zoom in perhaps to that middle bar, the focus for the quarterly talks about global debt, but actually zooms in a little bit more detail on the US. And some of the sentiment there is an observation that the US perhaps is late cycle. Perhaps let's expand on that observation, if we could.
Yeah, we touch in the quarterly, Lance, on a number of points to say, well, could we have not said this 3 years ago? Could we have not said this 4 years ago? Why is the issue now? Okay, why are we getting late in that game? Here on the screen, we've sort of identified a number of points that really academic studies have shown have coincided with periods where there's had to be a debt, the change to the debt profile of any country. The first of that is the absolute level of debt. And, Rogoff and Reinhardt, for example, talk about over 100% of government debt to GDP, typically as a threshold where it becomes really in a high risk zone. The second key thing is, as we've said on the right-hand side there, you're continuing to see the deficit get larger and larger. So actually the requirements on a year-to-year basis just are accelerating away to be able to continue to provide what they've suggested they want to their population. The third key thing, and this puts a little bit of a fire under the belly, is obviously the total amount of government outlays that are going on actually spending, going to interest payments. So there's a limit to that.
Yes.
There's no surprise, of course, that the US administration has been trying to jawbone down the interest charges. They're trying to actually get the Federal Reserve to get more involved,
Yes.
Too late, pal, and so on, because we've seen a very sharp rise in the amount of US government outlays that are going to interest costs, most of which, of course, is being sent offshore. So that's not even retained in the US itself. And then finally, you get in this late stage dynamic, the wiggle room to make tough choices gets much more difficult. And what we've seen there is that really over the entirety of, really since the 1960s, you've seen an ever declining amount of government outlays that are going on things that are a choice. And of course, that means that you've got much less wiggle room in terms of, as a community and as a population, being able to choose what you're going to fund or what you're not going to fund. And I think the reason that we have the photo that we do there is, of course, the Doge initiative, which got a lot of fanfare, at the start of the year, lasted all of about 6 or 7 weeks. You just don't hear about that now. And I think the next slide that you've prepared is going to show exactly why that is.
Definitely. I think you're reflecting on the Doge comment. It's obviously front of mind, but the ever decreasing wriggle, as you call it, is pretty apparent in this chart.
Yeah, 100%. So what we're looking at here is really the dark blue lines in each column, or the dark component of each column is really just showing you the already spoken for government outlays as a percentage of the total budget.
Yeah.
So you can see in 1962, only $30 per 100 was sort of spoken for on the start of the year, the budgetary year. Okay, what are we going to do with the rest of the $70 in terms of what do we want to fund and what wiggle room do we have? And you can see that has only moved one way over the course of the entirety of certainly my lifetime, and we're left now with a situation where less than 30% of total US government outlays are actually discretionary. So when you think about the total size of government outlays with 30%, you're kind of saying, Doge was suggesting that there will be absolutely no discretionary outlays at all. So, the idea that was ever likely to be achieved was 100% fanciful, unless you're living in a libertarian dream.
Well, how far can you pull back? I mean, looking at this, it's a trend that's difficult to fight.
You simply can't. I mean, you can, even if you halve the amount of government programs that were discretionary, given the total government outlays, that would only be around about $1 trillion. So you would still be having year on year a deficit. So what happens, of course, is that has been funded, as we showed in the very first slide, by private sector capital from the rest of the world. Nearly 2 trillion of Australian retirees, European savers, people in the rest of the world have been putting their money into US assets of all sorts to fund that gap. And in a multipolar world, governments are increasingly in the rest of the world and regions trying to co-opt that money to be able to support and develop their own domestic or regional agendas or requirements.
So that puts even more pressure on that assumption that they can just continue to get money from the rest of the world, right?
It does. I mean, it's explicitly changing the capital flows through macro-prudential and taxation, really. I mean, it's not like you just direct people that they can't own, US assets of any type.
Yep.
Capital will go wherever it thinks it's going to get the highest return, but you are starting to have tax incentives and macro-prudential requirements that mean the cost of putting money into a particular region, in this case the US, is much higher relative to keeping it in other regions, particularly domestically.
Hey, maybe we switch gears. So a lot of the slides we talked about are very much macro themes. As you say, the longer your horizon, the more this should matter. As bottom-up investors, as an investor yourself deploying capital, maybe let's take a step back and say, in light of all of this, how do you approach this environment?
So from a longer term perspective, and let's bear in mind, in the longer term we're all dead, so I sort of get that.
It's that long.
But if you were sort of building a portfolio today with a really quite long horizon, then the areas, by implication, if what I'm suggesting transpires is true, then you really want to be looking at or thinking in these ways that we've got on the screen here. First off, you actually want to be thinking about short duration assets, because at the margin, when there's a fight for capital, all else equal, that is more inflationary than deflationary relative to what we've been used to. Okay, now that's a long-term playbook. That doesn't preclude the cyclicality of deflation, inflation, but longer term on the margin, it's a lot more inflationary than deflationary. And of course, you want to be paid back faster. And as those jaws go further and further wider, the terminal value becomes a much greater part of your valuation. Whereas if that comes to an end, then that's something where you want to be in cheaper, shorter duration assets. So that's the first thing. The second key thing, and this is right across all asset classes, is you want to absolutely make sure that there are strong balance sheets. And really what I mean by that is businesses, projects, assets and so on that are able to finance themselves. Because we've been in a relative era of easy capital, and now we're talking about governments, the number one debtor, which will always get paid, are starting to fight for that capital. That means that you do not want to be at the mercy of relying on external funding markets. Credit spreads are very tight today. That will, over time, I think, go higher. If you're taking a long-term view, I mean, we're pretty much at the all-time tight, so that's no great insight. But secondly, I think that if I was pushed, and you and I were chatting about this the other day, this is sort of coffee and beer chat, I think if there's one big upside surprise over the next 5 years, it's that the listed corporate sector will be actually using equity to fund its business in a much greater level than it has been over the last decade. So make sure that the assets that you own across all asset classes are able to be self-financing and not reliant on a squeezing kind of credit pool effectively. The third thing, real assets. So really we're talking about this era of, financialization. So kind of real assets versus fiat assets. So things like, they've had a very good year already, but like TIPS is clearly interesting from that perspective. I think you're looking at infrastructure and the like. The only caveat, which we mentioned last time on the quarterly, is of course, when you've got assets in the ground, governments are able to tax it because you can't move it. As people who live in Victoria, second homeowners have just simply been taxed because the Victorian government is, for all effective purposes, kind of bankrupt, and therefore you can't move your second home, so you just tax it more. Well, that's been repeated over history, so that's my only slight caveat. In the real assets, so think about where you have them. And then clearly the likes of critical materials. So, things like oil actually longer term look pretty good in that. It's very, very cheap on a per unit of energy basis, but also precious metals plays a role in portfolios. And then finally, listen, broken record here, diversification. Yeah. And really what we mean here is not diversifying into bonds. People who've listened regularly would know that I think that government bonds are certificates of confiscation the rest of my lifetime. So that's not part of the mix. What you're trying to do is have many more risk premiums that are spread based, so are not relying on inflation deflation, but have this contracted rate of return that give you a decorrelated source of return and reduce the overall portfolio coefficient. So that would be the four key things to think of conceptually when building portfolios today to be able to weather that change.
Great. Hey, let's step back to the title of today's session on opportunity knocks. I suppose a good place to start might be actually where are we? You've often said that you and the investment team aren't forecasters, but just really keen students of history. Mm-hmm. You play a very serious game of odds and probabilities. So in that mindset, and for everyone on the call, where are we?
Well, we know that about well over 70% of kind of, listed equity kind of assets from a market capitalization point of view are in the US. And that's why we're showing the US here. Without getting into the minutiae of which valuation technique and so on, we've just got a blend here of about 7 over history going back to 1800. And you can sort of see that today we're approaching the 99th percentile, actually, of valuation in the S&P 500. We've had a look at different eras when you've gone above 90 and what's that meant over the last 10 years. What was your best opportunity? What was the average and so on? And interestingly, in all instances, apart from nation building right at the start of 1800, when the starting valuation didn't have that track record, you've been sort of talking about 5% kind of nominal returns or worse from today's level. So there's many different things that people like to talk about, but the bottom line is on a blended basis of many forward, backward, earnings-based, long-term based valuation measures. It's very difficult to argue anything other than you're starting from a position that has always given you materially lower returns over the subsequent 10 years than people have been used to over the last 10.
I think actually with that in mind, we've often discussed, you get the benefit of price movements in the market, but what about the new dollar invested? What about the new allocation to a market? Perhaps, again, through the lens of odds and probabilities and keen students of history, that teal spot of where we are today, the right sentiment of being cautious, perhaps, if that's the right statement to make, right?
Yeah, this is just history, so it doesn't tell you anything about the future, but you do need, in an odds and probability sense, to believe that from this starting valuation or higher, you've never seen a positive annualized return ever over 10 years. So that is an annualized negative return for 10 years. And therefore, if you are going to continue to think that the US equity market is the best place to put money, you are betting that this is genuinely something that has been unseen and unheralded, which, from an odds and probability point of view, would be a complete outlier.
Yep, absolutely. Now, before we get into the opportunity, perhaps let's take a step back and through the same lens of where are we over the course of time, the interaction between the stable and the popular is also pretty extreme.
Yeah, so I mean, listen, people who are familiar, obviously, with our strategy, won't be any great surprise to see that we're sort of making 8.5% year to date in a market that's much stronger than that. Clearly, the strategy is one that doesn't rely on momentum. And what we're showing here is that the momentum returns, which have been about 20 points above the market on its own year to date, we put that return of the best 20% of stocks in just purely price, so they're the popular ones, right? The ones that are going up the most, versus those 20% of stocks in the market that are the most stable. And by that I mean, equity beta, but also cash flow, balance sheet, etc. So sort of the steady growers rather than the most fashionable. Now, as we talked about last time, momentum can be a good factor over the very long term. But what you're looking at today is the difference between the most popular, so those stocks that have gone up the most and continue to perform well, versus those stocks that are just doing fine, doing what they always do because there's not much variability, has only been beaten or has been extended to this level two other times, going back over the last 70 years. So this is what has led us to that poor future returns. This is the internal dynamic that has made the bifurcation of a whole range of performance or otherwise very wide. Between managers and strategies. And the third key thing is that I would highlight, whilst in the other two instances, those top 20% of stocks that were the best performing just in pure price terms, nothing to do with about valuation or so on, whilst they did push higher, that was short-lived and there was a very sharp reversal of that. Okay, you can see in the 1981 period, and bear in mind, the Schiller PE was single digit in 1980, so this doesn't tell you anything about the valuation, that there was a sharp reversal to the tune of, well over 40%. Okay, and that was the same as we saw really at the back end of 99 and sort of early 2000. Yeah. Remember, the absolute mega cap leaders in 2000 continued to go up until September. So we've seen this huge bifurcation between the most loved and the most steady that are priced to give you really good long-term solid returns. And I think we'll probably get into that in the portfolio section.
So the observation here on stable and popular, now correct me if I'm wrong, but stable as a factor has traditionally traded at a premium.
That's exactly right. So just going back to that first principles, remember, visibility of those, making an estimate of the nominal cash flows and your cost of finance. The more stable businesses, you have a greater confidence about that nominal cash flow growth, right? Because the variability within that is much lower.
Yes.
They typically have a much better capital structure as well. That's part of the stability premium that they have. And the variability in margins and gross margins is much lower. And so they typically are afforded a higher aggregate PE than the market because you have a greater level of confidence about how to be able to value them. A much wider, narrower variance about the range of outcomes. So the market recognizes that and typically ascribes a premium because they've got the most confidence in that cohort of stocks.
Taking the same view of kind of putting historical context around it then, what if we zoom in to stability?
Exactly. So what we're showing here is exactly the 20% of stocks that are the most stable in the market. Mm-hmm. And we're showing that relative PE 1 year forward premium or discount versus the market going back to, well, basically 50 years. And outside of recessions, where obviously they trade at huge premiums and then big discounts because the premiums blow out because everything else's earnings collapse. and therefore then they're at a discount, but it's really a function of everything else earning nothing, as it were. And so that pushes the variability around, and you can see that in the 08-09 period. But outside of that, apart from the period around 2000 to 2002, it's traded at a significant premium, typically between 10 and 15% to the market, just on a one-year forward PE, not making any claim about longer term than that. So it is commensurate that not only on the previous slide did we show that the momentum stocks, those that have been purely the best performing in price, are very extended. I've only seen that relative to the most stable stocks two other times in history, which followed a sharp reversal of that. But in absolute terms versus the market as well, stability has got materially cheaper. And that is quite unusual. As you can see, we really haven't seen that at all since, really the 2010, 2011 period.
And for those that are not that familiar with our strategy, is it fair to say, though, as a process, we're not necessarily welded to stability?
Not at all.
Yeah.
No. So remember, we are bottom-up investors. We simply go where the bottom-up value is security by security. I think the easiest way to understand that, Lance, is, say, 2016, we had about $75 per 100 of our investors' capital in the US. Well, that's down like for like, probably to about 34, 35% today. That's not a function of anything other than, good performance in the US equity market. Equities there getting more and more cheap on our framework from a bottom-up perspective, and other areas in the world looking much better, in the same way that financials was one of the biggest sectors in 2016. So banks, when I say financials. And today we really don't have any banks exposure. So you're absolutely right. We're not in any way targeting a factor. I think the way that we like to talk about it is we have the highest quality portfolio that we can afford.
And we'll dig into the portfolio in just a moment, but actually maybe a good opportunity just to take a step back and refresh the audience perhaps on the way our unique process, bottom-up security selection, concentrated portfolio, welded with a really unique implementation process, delivers some pretty distinctly unique outcomes.
Sure. So you captured them there. This is over the life of the fund. So the first thing is that, of course, we have this base load of alternative source of return. So that's from the options implementation strategy. So the volatility risk premium, along with dividends and any interest we receive, that really puts down a real base load of income generation that can be distributed. And on top of that, of course, we've created quite a lot of capital growth over time, which, as we realize, that obviously gets distributed. So we've comfortably had distributions well over 8% per annum in the last 7 years from that differentiated source in terms of the mix. So it's true income as well as kind of that good performance of the underlying assets. The second key thing, listen, this is a defensive strategy. I think most people are aware of that. Over the life of the fund, it's pretty amazing. We've only got 26% downside capture. I think we'll get into the more recent dynamics because of this market concentration and what's leading, and that's kind of been quite different. But if you've got $100 and the market goes down 10%, if you were simply in a beta 1 global equity ETF, your $100 would go to 90. Talaria, you go to $97, kind of 40. And of course, that's nice on the journey, but it means you've got more money working for you in the upside. And then the third key thing is we've got a much greater certainty of return. So that's a function of this contracted rate of return on, about a third of our capital, this option premium. But it just means that the range of outcomes in absolute terms is much, much narrower than the equity market. And all three of those outcomes continue to be generated really indistinct to other previous years.
I think we're going to call out some shorter time periods shortly, but it's worthwhile noting that in this webinar, we've now crossed the threshold of 20 years in terms of track record of delivery. So into the third decade, essentially. Hey, can we go back to, you mentioned the implementation process. You've got the equity risk premium. We're adding to that volatility risk premium, and you use the term base load. Perhaps we can almost explore the composition we're looking at here.
Yeah, great. Okay, thanks. I didn't actually expect that slide, so that's very helpful. All credit to you, Lance. Okay, what you're looking at here is really the disaggregation of the total return over 1, 3, and 5 years. If you look, say, at the 3-year number at the bottom of that column, so the dark blue block at the bottom, that's just saying that we have retained 396 basis points per annum of return from the premiums that we've retained. On top of that, obviously, we've added any dividends that accrue to the portfolio, and we get any interest because we've got large cash balances because, of course, every put is fully cash back. We're doing this to reduce risk. This is part of the reason that we follow this process. And really, the key point here is that there's been a very stable, consistent 600 basis points of return per annum on that 3 and 5 years. I'll just call out on 1 year. Slightly lower, really driven by the component of the premium that we retained. I think 3 things just to share on that. One, listen, equity, the pace of idea generation is relatively slowed, as you'd imagine, given the valuation backdrop that we've shown. Yeah. So our unencumbered cash has been at the upper limit of what we've ever been able to do. Outside of the Liberation Day tariff kind of sell down, where we actually put 5% of capital to work at really attractive premiums and buffers to loss, volatility has been pretty benign. I think the third key thing is that a number of securities that we own, and we'll come onto the portfolio in a minute, actually the exercise rate has been slightly higher because some of those equities, whilst they're delivering, have simply got cheaper. And so the equity component over the last 12 months has actually been slightly higher rather than slightly lower. So that's the real thing. But that's, we're talking about 30 basis points in, 8.5%, as I said, return. Yeah. So there's no real difference to that base load.
Right. Can we dig into the portfolio? So obviously would be great to cover holdings, but also an interesting exercise that you and the investment team do effectively constantly on repeat, thinking about the portfolio of the market.
I'd like to say I feel that my life is a lot more exciting than that.
No, it's constantly. It's always happening.
We're executing to a high standard is actually how we like to talk about it. Yes, we've shown this before. I think this is a very informative table about what your client's capital is actually invested in, what it looks like. Just as a reminder, Lance, what we do is we take all the gross capital at risk. We put that as if it were a single holding company. So, say we're a private company, a holding company. We index the sales to 100, and then we take the global opportunity set in terms of the pool in which we kind of hunt for areas to put capital to work in. We index those sales to 100, and then we can look pari passu down against the opportunity set in global equities versus the Talaria portfolio that we run on behalf of ourselves and our clients. I think I'm going to call out the same 3 things I did last time. I think they're incredibly important. The first thing is going back into that theme, strong balance sheets, around about a third the amount of total debt in the Talaria portfolio versus the market. You can see that $34 versus $94. I talked about the highest quality we can afford. You can see the second teal group from the bottom teal group of metrics, that efficiency and profitability ratios. Despite not owning a whole range of fantastic businesses, I don't think they're necessarily going to be fantastic investments, but fantastic businesses, despite not owning all of them really, you can see that from a returns perspective, the Talaria portfolio is higher quality than is on offer in the market. So, return on equity, return on total capital, EBIT over total capital, all materially better in a quality lens. And then here's where the rubber hits the road, really the valuation. The portfolio today, choose whichever metric you like, but is trading at around about a 43% discount to the opportunity set, capitalization weighted. Now, if I have a look at the portfolio as of today, I look at as if we'd owned that for the last 10 years, the Talaria portfolio has grown top and bottom line commensurate with the market. Okay, so they have delivered exactly the same earnings growth really as the whole market, about commensurate top line growth as well. and yet they're trading at a 42% discount. The average, it's always been at a discount if you had today's portfolio on a backward-looking basis, but that average discount has been around about 15%. The absolute low of the discount at the end of 2021 was about, I just want to check, but around about 30. So we're well below that. So the great thing about the starting valuation, and you would have heard me say this before, is despite returning more capital to shareholders, because of the lower starting valuation, the amount of absolute dollars that is retained by the Talaria portfolio to reinvest at these double-digit rates of return,
Yes.
the quantum is absolutely higher. So the bottom line is we've got a portfolio that's growing, both top and bottom line. It's ultimately, given we have an 8% discount rate, we want an 8% equity return. That's our hurdle rate for the direct equities. With the starting valuation, and given we do everything off the cash, the honest truth is that they don't have to grow to be able to continue to generate that, portfolio 9 to 11% per annum, come what may, that we've delivered over the last probably 1, 3, and 5, 7 years.
Yeah.
But I feel very, very, very good about the portfolio, honestly.
Hugh, in terms of kind of changes, and this is almost a question without notice, but kind of changes since the audience would have last joined us from a sector and region things. Anything there that springs to mind or was worth calling out?
Probably the biggest change, I think, since we had this last time, though, my memory is not to the day of July, whatever, but is energy's been rising. Energy's been a very poor performing sector.
Mm-hmm.
The equities have continued to get cheaper. The structural underinvestment in energy only grows, and yet it's going to be clearly part of the energy mix for a long time to come. And we're finding a number of opportunities in some of the highest quality companies within that space. I'd probably call out EOG.
Mm-hmm.
This is a company that has a double-digit cash flow return on investment, even at the oil price of 40.
Yes.
It's done a tremendous deal recently to consolidate one of its key basins. There is not much regulatory risk, concentration risk. There's no financing risk, and that looks extremely attractive. We're all pretty excited about that one. So energy has been an area that has grown. I think that's reflected partly in that United States on the regional allocation.
Okay.
So, that 43%, I've talked about the US being at that 98th, 99th percentile of valuation, and yet that 43 is higher than you would have seen, say, 6 months ago. So what's going on there? A couple of things. Remember, around about 5% of that is associated with equities that are listed in the US that are really, we're using the ADR.
Yes.
The Mexican retailer, Brazil's largest brewer. We had a Canadian oil company that was actually in the portfolio, but we used the US listing. So that's part of that. But really, the other thing is that kind of rise in that energy. So that would probably be the two things I'd really call out.
Just given the sentiment of the call today has been around now granted government debt, and just thinking about late cycle, so we do occasionally get questions around the financials holdings.
Yeah, I mean, if you're sort of thinking, hey, going back to that 1 year performance, I think, the market's up around about, we're up 8.5. I think the market's up, whatever it is, we're 15 points behind on that, right? On just 1 year, it's less on the 3 years. About 75 to 80% of that is just simply the tech and communication service, so the MAG 10. But banks has been a really good performer over the last 12 months. We have not been involved in banks. Remember, our financials exposure there, that's 8%, is really in two of the highest quality insurers in the world. One a reinsurer, one which reported yesterday actually is one of the world's best sort of private sector insurers. The banks, from a bottom-up perspective, the reason that we've avoided them, really a few things. There's no loan growth, so the core business is not growing. Secondly, and perhaps most concerningly, because we saw a few tremors last week, but the loan loss provisions that we're seeing through the banks are abnormally low. So they're suggesting that there's absolutely no poor credit in their books, whereas, of course, as a traditional bottom-up through-cycle valuation sensitive investor, so a value approach, a through-cycle approach takes that into account, and that is predominantly what we've seen. So interestingly enough, the banks, there's really been a story of re-rating as well. because they've been able to recycle capital because there's no real need for the capital because they're not growing on a fundamental sense.
Okay. We've covered quite a bit in the last few slides, so maybe bringing it down to some of the more salient points, but also observing that our longer term outcomes are over 20 years. And maybe let's contrast that to the last sort of 1, 3, 5.
Yeah.
Your thoughts on that?
Well, let's go back to the core 3 outcomes.
Yeah.
And then touch on the absolute return. The outcomes, clearly the distributions have been consistent, strong, come from diversified source. A component of that has been through good stock selection. So, we sold out of Gilead, for example, as you know, last year, which was a US pharmaceutical healthcare company that we did very well on. That kind of translates into, the ATO telling us we need to distribute that. But the real key outcome in terms of that volatility, you can see that is extremely low. Now, that's lower than our long-term 20-year track record by quite some distance. So it's been a very, very smooth journey with very, very few drawdowns, which is the second thing. The downside capture is abnormal to what we've seen in the strategy over the last 20 years. So have a look at the 1 and 5 year, for example, Lance. The 5 year, when the markets go down, we actually go up. And that's a function of really what I talked about in terms of that concentration in a small cohort of momentum-driven stocks. And so whatever they do dictates what the index does. We're not in them. And actually, we've had a reverse where the market then typically reprices these cheap securities versus the securities that have been performing very well. So our downside capture has been extremely low. And whilst this basis point risk in the market, just clarify what basis point risk is, it's really thinking about the total index, the representation in the number of stocks that really contain all the risk. So if you look at the S&P 500, it's the lowest all time. It's about 42 shares represent all of the risk in the S&P 500. Now, as you can imagine, we don't really own any of those 42,
yes,
for better or for worse.
Yes.
But it means that we are not exposed to that basis point risk in the market. And so the final thing is that, some of the, industry standard risk metrics actually look exceptionally high, not sustainably high. I mean, something like a Train or a Jensen absolutely cannot stay at that level, but it will stay as we transition, be that this year, next month, in 5 years, to that different regime in terms of the basis point risk changing. So I think the 3 key outcomes continue to be delivered: strong, diversified source of income, much greater level of certainty as exhibited by lower volatility, and absolutely lower drawdown capture in terms of losing less when the market goes down. Indeed, we make money when the market goes down over the last 5 years. As I said, the question here, I think if I was on the call, would be, hey, what about the opportunity cost? Because there's no doubt that the absolute return, which is in line with our long-term history, commensurate with what the overall B-to-1 market could have given you. I think we talked about that. The opportunity cost is only falling for the person who has a longer horizon. So the more markets go up, the opportunity cost falls. The opportunity cost falls as you see the narrower and narrower leadership in the market. So like I said, that about 80% of that performance differential is really around those 10 stocks, which just don't conform to our valuation criteria. Maybe they will at one time. So we're agnostic about whether they're in or out of the portfolio. We're only interested in the valuation. And so actually it's true to label. We continue to execute at a high standard, and the portfolio is extremely well set up to continue to deliver the outcomes that we have both on 5 years, but getting on to the next 5 years for the 25 years that we would have been running the strategy.
Thanks, Hugh. Just one last thing before I hand over to Al for questions. We have used this in previous webinars before, but I think this just highlights a few things. So perhaps bear with me, but what we're looking at here is ourselves versus 4 other global equity strategies. Those 4 actually being the largest strategies in Australia by assets raised. We talked about Popular earlier in the presentation. So you're looking at ourselves on a correlation matrix versus the largest 4 most popular global equity strategies. but also against the NASDAQ for those passive investors on the call versus NASDAQ and MSCI. And what you can clearly see is here, on occasion, you're paying active management fees to managers who are getting you pretty close to an index return. What I would also call out, of course, is that whether you're set against another active strategy, whether you're set against a passive or beta strategy, I think it's fair to say we play really nicely in the sandpit. So worthwhile me calling that out. Hugh, thank you for your time. I'm sure we have some questions with over 200 on the call. So Al, I'll hand over to you.
Terrific. Thank you, team. I'll start with a question from Tom Dorr. So it was just a comment around healthcare. Seems a high-risk sector given Trump's threats to pharmaceutical companies. Any comments on that, Hugh?
Yeah, I mean, it's hard to speak about the entire sector given that we're bottom up, place by place. Thanks very much for the question. I guess the way to think about that is that we have good visibility on the largest drugs. This is how we value it. We take sort of the visibility on the largest drug streams. We know how much they're spent. We know when those patents end. We know that collapses over 70, 80% year one. And we know how much they're spending on R&D. So we aggregate up those cash flows from the largest product lines. We look at that in relation to today's market capitalization, and it gives us a sense of the positive or negative value ascribed to future science. So that R&D spend. Then we've looked at each individual company over the last 10 and 20 years about the R&D productivity. So on something like Roche, for example, it would be suggesting, and they're spending about 12.5 billion of cash R&D spend a year, that it's got a negative 60, 65 billion market cap relative to the drugs that are on patent. And therefore, you're saying that there is 5 years plus the previous 3 years of R&D spend that will create not a single dollar of revenue to Roche over that period. That's what's in the price today. Lo and behold, actually, they've generated about $3 of sales for every $1 of R&D spend over the last 15 years. So that's the odds and probability game there, because clearly we don't know which billion is going to create the value. So the second way then, in terms of the risk embedded because of tariffs and so on, is, hey, tariffs is a pretty multifaceted risk. But is to say, okay, well, what is the level of profitability that would need to be reduced to match today's share price, where actually there's not a negative embedded value for new science. And effectively it's saying that Roche has around, think about it as about a 35% operating profit margin. Really, from a cash flow perspective, you would need to see that drop to around about 24, 25% to reflect today's share price, okay? Bear in mind, I know it's a long answer, but bear in mind that would be with no change to its cost base. So you're still running the same sales process, you're still running the same number of people, you're still running the same manufacturing, still running the same marketing, and yet, you're incrementally making one third less in terms of return on invested capital. So that seems both quite penal and an opportunity. That's the first thing. The second key thing is, of course, the one big bill is the flip side of that, and is a real positive. Remember, fixed asset investment, but particularly R&D spend, is expensed and becomes cash-free, right? So accelerated depreciation. So healthcare is one of the absolute largest beneficiaries of the big bill in terms of the cash flow return that Roche is going to receive. So they're really the two competing things. The third thing is, in our portfolio, there's a lot of transfer pricing. So obviously they're based in Ireland, and they sell in the US. Roche, for example, doesn't really do that. So actually the tax risk in terms of around that tariff is relatively lower. So they're probably the three key things that I would say. And the Pfizer negotiation relatively recently is a good way to understand the way that the industry may move forward.
Yeah, terrific. Thank you. From Jeff, what percentage of cash do you normally hold, and are the current levels at normal level?
No, thanks very much, Jeff. Yeah, the absolute maximum is 20% cash. So when we say cash, that's unencumbered as opposed to cash back in the options, just to be clear. No, that is the maximum level that we're able to hold. Remember that we benefit when volatility rises very quickly. Even if share prices didn't fall and volatility went up, we can do the same thing which didn't meet our valuation criteria, but we can commit capital subsequently, sort of a long way down. So I think I name checked Jeff in the Liberation Day tariff news where volatility went up over 50. We put 5% of the capital of the portfolio to work on that day at extremely attractive kind of premiums. If I go back to post-COVID, when a lot of people were raising cash, quite rightly, it was a 1 in 100-year event, really in that April to November period in 2020 before the vaccine became intervened. In each of those months, we were down to around 4% unencumbered cash because we could lean into the opportunity set, not only getting more money, more opportunities, but also upgrading the quality of the portfolio. So no, that is an unusually high level because of the bottom-up opportunity set currently that we're finding on a stock-by-stock basis.
Terrific. And then maybe just one more to finish up. And obviously, if we don't get to everyone's question today, we will come back to you afterwards. And there is a recording of today's session for those who would like to look at it later. We'll be sending that out in the next couple of days. But just as a last one, the gold rally, Hugh's been very prolific. Your thoughts on what that means and what's been driving that?
Yeah, great question. I mean, obviously, we've seen the photos of people lining up around the block in Sydney.
Yeah,
the predominant narrative is that it's this debasement trade. The government's going to continue to print, and it's ultimately an inflationary step. Firstly, debasement, fiat currency, and then inflation. Right at the start, I was suggesting this fight for capital long term is going to be on the margin inflationary. How high, I've got no view on. But we're not seeing that in inflation break-evens. We're not seeing that in very long bonds, apart from Japan, which is the debt is so high, but we really haven't seen a move on the very long bond. My personal view is that it's starting to reflect worries about the debt issue. And that is not something that I particularly read about. One of the reminders a conversation I had with a client recently was, if you go back to August 2007, I think the BNP funds really marked this, which got frozen. Their MBS funds got frozen, this fund in August of 2007. And that really was the start of the GFC. Obviously, we're in the foothills of that. Gold was about $660 an ounce then. Now, by September 2008, we had Lehman. Gold was $1,000 an ounce. And yet, actually, inflation was negative 4.5% then. So the idea that gold only goes up in this inflationary environment, I don't believe is true. And my personal take, and bear in mind we have just written a quarterly all around US debt, is that actually the gold price move to date is a reflection of the debt issue in the system, rather than actually the market talking about an inflationary issue. And I do think that comes later, but I think this move is a debt issue at first instance.
Terrific. All right. Well, thank you very much. And thank you, everyone, for your time today. CPD certificates will be sent in the coming days. Please reach out to our team at info@talariacapital.com.au if you'd like to discuss anything further. And as I said, a recording will be sent to everyone who registered for today's session. And we look forward to seeing you again. Thank you.